of politico-sociology here at Scuola Classe di Scienze Politico-Sociali, the founder really of our faculty, who will look more at the political and social aspects of the book and of Jonathan's talk, and eventually Mario Pianta, also from this faculty, and the director of the Istituto Ciampi. He is a political economist. Unfortunately, I have to inform you that Manuela Moschella, who is also on the list of speakers, is not able to be present for external constraints. So after that, we'll have a discussion, and I'm hopeful that the very distinguished audience of researchers and PhD students, some of them also working on economic, socioeconomic, comparative issues, will have questions. If there is anything you want to know about American capitalism, but you never dare to ask it today, is when you can do that. All right. Are we online? No. Yeah, we can see internally. I mean, we can see Luigi's online, but it's only us who see it. Correct? The rest of the world is blind at the moment. Fine. Luigi, I'm very sorry about this. But if you can open the work, we'll be grateful. Professor Luigi Ambrosio, Direttore della Scuola Normale Superiore.
Many thanks, Guglielmo. So good afternoon to everyone. I'm very happy to have the possibility to talk American capitalism in the age of chaos, where we will be introduced to the fourth volume of the monumental, as Guglielmo was saying, a monumental series of books on the history of capitalism in the US. And I think in this event, it will be covered the history of the last 40 years. A special welcome to our guests, Jonathan Levy and Pietro Catte of the Banca d'Italia. And I would say that this is a perfect example of the research and seminal activity performed by our Istituto Ciampi in Florence, a young institute, but already very active, very visible, whose activity sees the participation of the three classes of the Scuola Normale, and particularly in this event also the Classe di Lettere will be represented by Professor Pons. Let me also emphasize on this occasion that the Institute and the Ciampi chair are based on it, not only live with the funding of the Scuola Normale, but also with the generous funding of many other institutions, including in particular the Banca d'Italia. So I'm sure you will enjoy this event, and I leave the floor again to the chair, GUGLIELMO MEARDI, Dean of the Classe di Scienze Politico-Sociali. Thank you.
Thank you very much, Luigi. We will now start with. I would ask the technician to give us a sign if we manage to go live, so I can just make a little clarification of what is going on. If are we online now? Oh, okay. Oh, well. Welcome to everybody to the Scuola Normale Superiore and the Istituto di Studi Avanzati Carlo Azeglio Ciampi for today's event on American capitalism in the age of chaos. I'm grateful to Direttore Luigi Ambrosio for having opened the work, and I'm Guglielmo Meardi, the Dean of this faculty, and I immediately give the floor to Professor Jonathan Levy, Professor of US History at the University of Chicago, for his talk. Jonathan, if you can... yes, it will. The floor is yours.
It's on. Is the microphone on? It sounds like it. Good afternoon. Thank you very much for the introduction. Thank you for the invitation to be here today. It's a particular pleasure, in part because it gives me the opportunity to say thank you. As I say in the acknowledgments to the book, it was here, I believe it was 2017, that I finished writing the book, thanks to the invitation and the hospitality of Professor Della Porta and Professor Pianta. So it's really great to be back where the book was finished. It feels like somewhat of a coming full circle. So I'm looking forward to our discussion today. Are the slides okay?
Yes.
Okay, good. Ages of American Capitalism is a history of American economic life from the English colonization of North America in the 17th century through the Great Recession. It stops in 2010. It's divided into four parts. There are four ages. The first, the age of commerce. It's from the English commercial colonization of North America through the Civil War. Just to give a sense of, I'll come back to this slide later actually, but the first part of the book ends with the Civil War over slavery. This is a map that shows the concentration of slaves in the U.S. economy in 1860 on the eve of the Civil War. The abolition of slavery marks the second age, the age of capital, which is an era of industrial revolution. It's a slide from the early oil refinery in Pennsylvania. I also underscore, in addition to, in addition to industrial revolution, the rise of modern finance, the appearance of macroeconomic volatility. This is sort of the culmination of the second industrial revolution in the United States. This is the first assembly line at Henry Ford's automobile factory. Both industrial revolution and also financial volatility, they culminate in the 1920s. First, this is another a pictorial representation of River Rouge, the largest industrial factory in the world when it was built in the 1920s. So this part culminates with the birth of Fordism as represented here, but also with the Great Depression. This is the panic after the great crash of the New York Stock Exchange in 1929. The Great Depression, the election of FDR, and the coming of the New Deal marks the third age, the age of control, which lasts from the New Deal through 1980. Here we see the rise of the United States as the world economic hegemon. The book deals with the contours of the post-war boom, including the rise of consumer society, represented by Andy Warhol pop art here, and also the 1970s crisis of industrial society. And then the final age from 1980 forward, the age of chaos. Here, the chapter of the book deals with Houston as the kind of typical city of this period. This is a famous skyscraper from Houston that kind of marks this break in time in the 1970s. And then here's a slide from the financial crisis of 2008 that I'll come back to at the end of the talk. So it's this age, from the election of Reagan to the celebration of the new economy, to the rise of finance in the Great Recession of 2008, that I'm going to focus on in my remarks today. But before I do that, I want to say a few words first about the conceptual apparatus that's at the heart of the book. And the biggest challenge in writing the book, besides just fatigue, because it's too long, was writing the last part. In part because the history is so recent, extending beyond even what most historians would think of as the contemporary. But I also think it's because so many received meta-narratives of economic history have a certain logic to them, in which the endpoint is industrialization, modernization, or perhaps the rise of a market economy, that really treat the endpoint of economic history as the post-war period, I think. And one goal of the book is to try to make sense of this post-1980 period on its own terms, rather than calling it post-industrial, post-Fordist, postmodern, or even neoliberal. All terms which I think are very helpful, but define the post-1980 period through what they're not, as opposed to what it is, this period. So to help do that, I turned to some actually old economists, old economic thinkers, mostly the early 20th century American economist Thorstein Veblen. But I'm not going to talk about him. Also, another inspiration for the book is Keynes, the English economist John Maynard Keynes. So I want to say a few words about how Keynes informs the book, especially my analysis of this last age. But this is Keynes from the general theory. And he says there's been a chronic tendency throughout human history for the propensity to save to be stronger than the inducement to invest. What he means by that, I think, is that all things being equal, owners of wealth, owners of capital, prefer to hoard their wealth rather than part with it and incur a risk of long-term investment. So the inducement to invest long-term in productive enterprise usually is rather weak, and with bad consequences, given that investment in any possibly Keynesian account, and mine is one, is the most dynamic factor in economic development. Now, Keynes wrote Propensity to Save here. Usually he used the word hoard, which in his technical lexicon is another way to say liquidity preference. So it's the security of liquidity that owners of wealth prefer to the risk of committed investment in enterprise, production, and labor. Now, when we think of liquidity, we usually think of just money or cash for use in transactions. But for Keynes, money is not just a means of transaction or exchange, a flow variable, a means or an issue of transaction demand. For Keynes, money is also a stock. Money can be a capital asset itself, and liquidity preference speaks to the both speculative and also precautionary demand for holding liquid assets. What are liquid assets? These are assets that first store value over time, and then second are easily transactable. They always have a willing buyer. So in this account, owners of wealth must choose where to invest, which forms of capital to own or hold, and with the institutional setup that is capitalism, money and money-like assets are among those choices. So historically, and this is sort of the sweep of the book, given that assets that wealth owners hold, whether they be land or slaves, factories, real estate, credit instruments, money, flows of income and qualitative patterns of enterprise, production, labor, and consumption follow. And it's that process of investment, being the first mover, working its way over time through production, through exchange, and consumption back to investment. That is the kind of economic vision of the book. That's the conceptualization of capitalism. Now, liquidity preference, just one more quick thought here, it also brings into the picture quantities. So money might be the most liquid asset, but money produces nothing. So liquidity preference, all things being equal, means lower demand, lower trend lines in output, productivity, the lesser employment of resources, including labor, and higher inequality. So liquidity preference basically translates into an inegalitarian rentier capitalism. Now, historically, and again, I'm sort of referring to the larger sweep of the book, eras that have seen the great expansion of productivity and wealth, slave economy, the Industrial Revolution, involved capital investment in illiquid assets. To come back to Fordism, here's a representation of sort of illiquidity, where a factory pictorially is represented as sort of part of the natural environment, where the smoke of the factory melds with clouds in the sky. They're indecipherable. But, and this is kind of Keynes's point, we should not expect to see that happen. Instead, we should expect to see liquidity preference. That's the rule. Now, why is that so? The reason is that the speculative and precautionary demand for liquid assets work in unison, expressing a desire to keep all investment options open for speculative gain without bearing the risk of a loss. And that's really, I think, the ultimate sort of capitalist fantasy. Immediate entry and exit into all asset classes in pursuit of immediate speculative gain, but with no risk of loss. If you can get that, why not have it? I keep saying all things being equal, liquidity preference, but of course things are not always equal. The book explores many factors that have strengthened historically the inducement to invest. Cultural norms, law, at times social movements, like labor movements especially. But the key actor in the book here is really the state. So it's the state that has the most power to energize or not investment. And the relationship between politics and investment is really at the core of the book. So for instance, wars matter greatly. Most long-term investment booms have wars behind them. Industrial Revolution in the United States, the Civil War, or we can think of in the United States, also Europe, World War II in the 20th century. On the opposite side, for owners of wealth to be able to exercise liquidity preference, they need the state to create suitable conditions. So I spoke of this sort of ultimate capitalist fantasy of immediate, speculative, riskless returns. And I think that fantasy, arguably, is the situation that we have today, or have had for a very long time, in large degree because of the way that central banks backstop asset prices. How did we get there? So what I'd like to do now is shift and just focus on a few moments in this age of chaos that I think are particularly revealing or were particularly consequential and important. The first, speaking of central banks, was the Volcker interest rate shock of 1979 to 1982. And then I want to talk about the new economy of the late 1990s. And then just briefly a few words about the global financial crisis of 2007-8. And hopefully paying attention to these three moments, sort of the main features of this age will emerge. Okay, so the Volcker interest rate shock refers to the dramatic interest rate hikes of the U.S. Central Bank when Paul Volcker became chairman in 1979 and lasted until 1982, which ended the severe price inflation of the 1970s. This is inflation expectations. You can see how high they were in the United States in the late 70s. They come down. These are interest rates, so the interest rates went as high as almost 20% to bring down inflation. In the book, in my account, it's really the Volcker shock, not Reagan. I think Reagan has been given too much credit for these changes. But the Volcker shock is the best place from which to narrate the broader economic transformation that occurred over the 1980s that first created this new age of capitalism, which I think still today, certainly until COVID, I'm sure we can debate this, monetary policy has remained from this moment the central arena of economic policy making. That's a central feature of this age. So the Volcker interest rate shock through high interest rates, choked off credit, led to a sharp recession in the United States that lasted from 1980 to 1982. And high U.S. rates, in fact, plunged the entire world economy into recession. But while much of the world remained economically depressed over the 1980s, the era of the Latin American and also the African debt crises, for example, beginning in 1982, the United States enjoyed a boom, a very long macroeconomic expansion. Now, part of the significance here is that from this moment, we see a new form of global U.S. Economic hegemony. So in the post-war period, like most powers in the past, the United States, at the apex of the world economy, exported capital and exported goods to the world on net. This interest rate shock brought enormous inflows into the U.S. capital market, thus bidding up the dollar, which you can see here. And so in this post-1980 configuration, which is new, I mean, I don't think there's ever been a prior historical example of like this, the United States is still at the center of the world economy, but relatively it's importing capital, and over time becomes ever more so the consumer market of last resort for the world's producers. So during the 1980s, a lot of Japanese savings arrived into the U.S., helping finance U.S. budget deficits and also U.S. consumer purchases of Japanese goods. The West German, then German economy has a similar relationship to the United States, and the pattern just iterates into the 21st century with the rise of China. This is the current balance. So you can see this really comes out of the 1980s. There's an interregnum in 1990, and then the late 1990s. These new relationships between the U.S. and the world economy only amplify. Within the United States, the high U.S. dollar undermined U.S. manufacturers, especially steel and auto, that were exposed to international trade. And during this recession in the early 80s, there was a massive sort of purge of fixed capital in the historic Northeast, Midwest United States manufacturing belt. Really been the anchor of U.S. manufacturing and the U.S. labor movement since the 1880s. So a marked shift coming out of the Volcker shock in the pattern of U.S. capital investment away from long-term illiquid productive capital investment, especially in manufacturing, bringing rise to the process of de-industrialization, massive losses for the U.S. labor movement, and also the 1980s U.S. macroeconomic expansion uniquely. Here I just showed this latter age, but it's true of all of American economic history. It's the only boom in which you have a declining share of fixed investment to GDP, the only macroeconomic expansion of its kind in all of U.S. economic history. So basically what you see is capital shift back to where, if it can, I think we should expect it to go, which are liquid assets. First, with the high interest rates of the Volcker shock, we see capital seek profit through interest rate accrual. So just putting cash in the bank and earn profits on interest rates. That kind of profit making had accounted for 1% of profits for non-financial, basically industrial corporations. With the high rates of the Volcker interest rate shock, by 1982, 31.4% of all profits in the non-financial corporate business sector came through interest rate accrual strategies. That's sort of step one in this shift. Step two was a turn towards short-term profit making through capital gains, riding the credit cycle. So interest accrual is a component of financial, or what's called portfolio income. So for U.S. manufacturing firms, in 1978, financial income was 18% of total profits. By 1990, it's 60%. That is stable since 1990. Most manufacturing firms in the United States make profit, the majority of their profits, through financial strategies, not through commodity production or the production and sale of industrial goods. Here, in addition to the Volcker shock, Reagan's deregulatory efforts in financial markets mattered greatly. So the way, before this moment, the way U.S. capital markets works, they were regulated according to geography. So they're siloed. You can't move capital across different asset classes. But deregulations in the 1980s makes it easier to move capital and credit across different sectors of the economy. And one of the places capital goes is in leveraged buyouts of industrial corporations. As a phenomenon of the 1980s through a new market in junk bonds. This is a painting. It's called Drexel, Burnham, and Lambert, which was the Michael Milken's firm. He ended up going to jail, but was the central kind of bond trading firm of the 1980s. And it's a pictorial representation of deregulation in a way. I mean, you can see there's different spaces, but they're all connected by the same line, even though he uses different brushes. So here you can really see through artistic representation this new emphasis on flow, right, on the free flow of capital in the 1980s. Now, historically, the 1980s represent a very unusual moment in capital markets. It's a speculative credit boom, but at very high interest rates. Interest rates were very high in the 1980s because there was still fear that inflation would return. Booms like that tend to become self-fulfilling because with high interest rates, there's a high hurdle rate to make a profit in excess of the cost of the loan, given high interest rates. So one way to juice profits is just to increase leverage, which means you're going to see more debt, and more debt. And that happened in the 1980s. Debts of all kinds public and private, household and corporate, exploded. Now, the last time something like that happened was in the 1920s. It was after World War I with the restoration of the gold standard, and the 1920s saw a speculative investment boom, riding a credit cycle that led to the Great Depression, but it also funded the rise of Fordism, right? It funded Fordist mass production. The 1980s is similar. It's speculative. It relies upon credit, but it's also very different in that it funded deindustrialization instead of industrialization. What did it fund exactly? If you look at the 1980s, well, a lot of finance for the sake of finance, centered on Wall Street, including leveraged buyouts by firms like Drexel Burnham and Lambert. But the chapter in the book on the 1980s also has a long section on the thriving commercial real estate market of that decade. One, because that's the world that Trump comes from, 1980s commercial real estate. And he was great at this game until he wasn't anymore, which is you use debt, you use leverage to juice asset prices, you live by borrowing off of asset price appreciation. You don't have to worry about the underlying profitability of the business. But it's also true that the United States had a boom in the 1980s, unlike Western Europe. Actually, Japan is another country that had a boom in the 80s. It looks very similar to this. But the United States had a boom in the 80s because it grew what's called the United States Sun Belt, which is a region geographically that stretches across the U.S. South, Southeast, and then west through Texas to California. So in addition to Wall Street, which is unique somewhat to the United States, the United States also has more so than already industrialized countries who were suffering through industrial crisis of the 1970s, capitalist countries, also communist countries. The U.S. has this kind of burgeoning high consumption service economy. I mentioned consumption, but with the decline in investment, the flip side of that is we see consumption becomes ever more important, macroeconomically speaking, to driving the U.S. economy. So high consumption service economy, real estate is the center of it. It's also very much tied to the growth of a service economy, business services and finance, retail, hospitality, healthcare, and that's where the U.S. economy expands over the 1980s. New economic structures, new forms of social life, and also politics tied to it as well. Now, here's how I characterize this broad transformation in the book. It's the rise of a new political economy centered on asset price appreciation. So in the post-war period, income growth in the economy very much depended upon the depreciation of industrial capital. Build a factory, incomes, profits, pay by using the capital. The value of the factory, the asset, depreciates over time. It loses value as you use it. It's also fixed capital. It's stuck on the ground, literally, and you need labor. You need a lot of labor to realize profits. And so you get a classical kind of industrial class structure at work. This is, again, the world's first assembly line at Henry Ford's factory. This is a famous photograph in U.S. labor history, got a strike, a photograph of a fight that broke out in a strike when the United Auto Workers tried to unionize and failed the Ford Motor Company in '37. It would only succeed during the war. So in this setting, capital needs labor. And labor, at the same time, could also contest capital because it knows where capital is. It's right in front of its face. Fighting to translate the productivity gains of using capital into pay gains for labor. And so you see this linkage. This is common across, this is common in Europe too. It's particularly dramatic in the United States. You can see in the post-war period, productivity gains in the economy are hitched to hourly compensation. And then in this period since 1980, of course the link actually is broken in 1970, we see a widening gap between average pay and productivity. This post-war period, for 40s, 50s, 60s, I call this an era of income politics. that saw redistributive politics, again, organized around pay and labor earnings from incomes yielded from industrial capital. And in this capitalism, the central figure was the male head of family. That's where you're channeling income, but also welfare entitlements. In this political economy, it fits and starts. It comes out of 19th century Industrial Revolution, and it reaches its culmination in the decades after the Second World War. Now, after 1980, income generation shifts towards property, away from labor, through liquid asset price appreciation instead of depreciation, aided by leverage, aided by debt. Stock market's up, real estate market's up. Those assets throw off incomes to property owners or as labor income to financial and business service classes like bankers, lawyers, accountants, even though it's classified as labor earnings instead of capital gains. Mario's book is really right on this. Okay, this creates new patterns of rising inequality, certainly, because income generation shifts towards property owners. The rich tend to own most of the property. By definition, they benefit. But it also created in the 1980s, the US, just booming service employment. Again, whether high-wage financial and business services or low-wage, historically feminized jobs in services, retail, healthcare, industries that feature low productivity and low pay. Okay, so I said much of the world experienced an economic downturn over the 1980s. The US doesn't. It has a genuine boom, but already in the 80s, you can see some very troubling patterns which persist across this whole period. Economic growth that depends upon debt of all kinds for demand, especially given the rise of inequality and stalling wage growth. Dependence upon leverage for profit making, which bloats the size of the US financial sector, and then low trend line rates of productivity growth due to the explosion of the service sector. Okay, what's next here? Let me talk about the new economy of the 1990s for just a little bit. I said the Volcker shock's the moment that brought monetary policy to the forefront of economic policy making. I think Reagan and a lot of his advisors were rather ignorant when it came to the economy and tended to be mostly ideologues. I think the 1990s, Clinton, the economic team around him, they're different. I mean, they're quite sharp and they have a very coherent ideology. Call it neoliberalism if you like. Involves the deregulation of markets and just a complete faith in financial globalization, tied to a center-left belief in equality of opportunity, the special emphasis on equality of opportunity for historically disadvantaged minorities. Now, Clinton and his team, they also believe in the primacy of monetary policy and central bank independence. And the late 1990s, Volcker's successor, U.S. Fed Chairman Alan Greenspan, I mean, he achieved sort of celebrity status. This is him addressing the U.S. Congress in 1998. He's celebrating the new economy. This chapter in the book on the new economy, it focuses on Silicon Valley, the rise of the great technology companies, Apple, Google. It explains how the network became the dominant principle of business organization, but also social life in general, culminating with the rise of the social network, although I deal with Facebook, because Facebook grew across the 2000s in the next chapter. So it deals with this kind of social and business history of the internet, but it also keeps the focus on capital investment. And coming out of the 1980s in the United States, because of financial deregulation, and also because of capital imports into the United States from around the world, I mean, there's just this astonishing amount of capital and credit rushing into the U.S. capital market, which by the end of the decade, the end of the century, was bidding up really into the stratosphere U.S. technology stocks. This is the technology index, the NASDAQ. So this is, I mean, again, the capitalism of asset price appreciation. At the same time, the late 1990s, up until today, was the one moment in this age when it seemed to kind of be all working out. I mean, a lot of leading indicators, employment, output, productivity growth, actually looked to be picking up in the late 1990s. 1998, however, there was a crisis. Another pictorial representation of flow by the great German photographer Andreas Gursky, who took a lot of photographs of the world stock exchanges. This is from Tokyo. 1998, there's a global financial crisis, which started in East Asia, came out of the speculative yen carry trades, which is why Japan's up here, which triggered massive speculative capital flight, first from Thailand, then from other Asian countries. And that's the context in which Greenspan is addressing the U.S. Congress here. I'll read what he says. In short, our economy is still enjoying a virtuous cycle in which, in the context of subdued inflation, that goes back to Volcker, and generally supportive credit conditions, rising equity values provide impetus for spending, and in turn, the expansion of output, employment, and productivity, enhancing capital investment. The hopes for accelerated productivity growth have been bolstering expectations of future corporate earnings and thereby fueling still further increases in equity values. I mean, that's the sort of perfect distillation of asset-led growth. He's explaining why, in the context of the East Asian crisis, to soothe the nerves of wealth owners, he was bringing interest rates eventually down to historic lows. It's the bottom line here on this graph. It actually starts with Volcker. In 1982, there was a crisis having to do with the Mexican peso. Starts then. But this age and this East Asian financial crisis is another instance of this. Government authorities, chiefly the United States Central Bank, the Fed, prove their willingness time and again to backstop this new political economy of asset price appreciation in order to ensure macroeconomic stability. But Greenspan, who was actually always quite honest about what he's doing and quite clear about it, you could see in his words in 1998, behind him is a hope. I mean, nothing more than a hope. He says, the hopes for accelerated productivity growth have been bolstering expectations of future corporate earnings, thereby fueling still further increases in equity values or technology stocks. It turned out that many 1990s internet companies were actually not profitable at all. It turned out the productivity gains promised by the internet didn't show up either after the late 1990s. And in 2000, the US stock market collapsed, but Greenspan keeps coming to the rescue. You can see by 2003, interest rates are at 1%. Keeps coming to the rescue to provide supportive credit conditions for the United States economy, which meant the recession of 2000 and 2001 was rather mild in macroeconomic terms. But this leads us to our third and final moment, the financial crisis of 2007-8. Now, the first decade of the 21st century is covered across the last two chapters of the book. And I begin, or the title of the second to last chapter is The Great Moderation, which is quoting Greenspan's replacement, Ben Bernanke. Bernanke in 2004 labeled the period since 1980 the Great Moderation because of the lack of macroeconomic volatility since 1980 relative to previous eras. And Bernanke credited largely monetary policy in creating price stability, the lack of inflation for this era of moderation. After 2008, nobody talks about the Great Moderation anymore because there's one of the crisis since the Great Depression. I emphasize that if economic development is led by asset prices and debt, so long as the Fed can ease and give supportive credit conditions, it's possible for expansions, if of a certain kind, to continue. Now, the asset prices that drove the 2000s expansion in the United States were homes, was residential real estate. I mean, it's deeply rooted in the U.S. past, but I come back to this. This is a painting from the 1850s, from this period in United States history, in painting, lots of these representations of the United States as kind of open space waiting to be settled and conquered by homesteaders. So this is a kind of defining feature of American political economy. It goes way back to the expansion of the agricultural economy earlier, and we see it showing up again in the 2000s through home ownership. It's the one moment in this age of chaos when it looked like the economy of asset price appreciation was being opened up to not just the rich, but also the masses through home ownership. But again, it's growth through leveraged asset prices and debt, not through the growth of labor incomes. Now, I emphasize, especially in the book, where the phenomenon, where the mortgage crisis took place. It takes place in the Sunbelt service economy that I was speaking of earlier in the 1980s. So this is a map that overlays, there was a real estate crisis in the 1980s that looked very similar to what happened in 2008, not quite as big. This is a map that overlaps the most intense places in the United States where the crisis took place in the 80s and also 2008. And you can see they line up, and it mostly takes place in this sort of Sunbelt region I was referring to earlier. It also takes place in regions of the United States that suffered from the so-called China shock, so a loss of manufacturing jobs throughout the United States due to competition from Chinese exports abroad. This is a map that shows the parts of the United States where that happened, and the highest quartile, most exposed, is a place where the mortgage crisis particularly intensified. And so the U.S. economy in the early 21st century starts to reveal just huge regional disparities. But you have some rural regions left behind by globalization, altogether. Some regions that are able to turn to leverage real estate, inner cities still suffering from deindustrialization, or this Sunbelt regional growth pattern. And then layered on top of it, you have a flourishing Wall Street, a flourishing Silicon Valley, and also other thriving urban economies. They tend to be on the coasts. You could add Chicago into that mix, driven by the high-income service economy. Google, Facebook, Amazon, unlike the 1990s, these companies become highly profitable in this period. Many of them become monopolies. Okay, this boom comes out of the mortgage housing market. It's quite brief. It only lasts from 2003 to 2007 before the global financial crisis sets in. This is a neighborhood in Las Vegas that had been part of the mortgage boom that gets abandoned in 2010. So for the interest of time, I think I won't recount, the events of the financial crisis. The book tries to do that. Suffice it to say, the U.S. Federal Reserve comes to the rescue of asset prices again. The central bank remained the most important player in economic policy across the era of the Great Recession, which I think didn't mark a divide, didn't make for a new age. We can certainly debate the policy significance of what the Obama administration did after 2008. But I end the book with the pivot towards, which was a global pivot, towards austerity in 2010, and argue that basically by then the pre-2008 system had been put back together again, that the 2010s expansion, which goes through Trump, until COVID saw the same dynamics occur. So I end the book calling Bernanke's Great Moderation actually the great repetition of the same economic pattern that first took set in place during the 1980s. Oh, let me conclude. Let me stop there, actually. But just with the following thought, and then I will stop, which is something I haven't addressed yet, which is why chaos? Why the age of chaos? Why not the age of finance? Why not the age of inequality? I think that would work too. If you wanted to call it the age of finance or the age of inequality, it wouldn't bother me. I suppose with chaos, I was trying to capture important qualities of the social experience of post-1980 capitalism that also address the relationship between politics and economics. So I suppose chaos most refers to the collapse of old industrial structures, whether factories, the male head of household income, single income family, or class politics rooted in industrial structures, economic structures. So the collapse of those and their replacement first in the 1980s with far more short-term, mutable, dare I say liquid principles of organization, ranging from mutable social networks to dual earning households or single earning households. And then, of course, also the fickle character of short-term speculative global capital investment. Now, I think there's good evidence that recently, I think certainly the 2000 teens, that this chaos dimension of the political economy is changing, that you can kind of see a hardening of new structures of power and exclusion. And we've learned that actually networks aren't just mutable, they exclude. The rise of the big tech companies are monopolies, they're sort of citadels of concentrated power. And of course, when we think of inequality, the hardening of inequality in this period, it doesn't look like chaos, it looks like domination, it looks like the exercise of power. With that said, I still think the defining feature of this age was the ever-increasing liquidity of global capital and the related inability of states, social movements to literally fix capital on the ground long enough in order to contest it socially and politically. And in fact, we see the opposite, the desire of states to facilitate capital mobility by ensuring the liquidity of financial markets. So if you sort of look at this slide here up on the screen, I mean, I think this is the perfect slide that tells you what the 2008 financial crisis was all about in the United States. I mean, credit has fled, construction has fled, but you can see here there's no people, there's no community, it's literally empty. And you know, scholars are still trying to explain why the 2008 financial crisis didn't lead to a social movement of people who had been foreclosed upon by banks during the financial crisis. It led to other kinds of social movements, but not one rooted in the economic structure that was responsible for the crisis itself. So chaos also refers to a loss of social and political control over the economy. And I think that's been true since 1980. And really the one great exception, which is China, is the exception that proves the rule in this period. So to say, that I will conclude, but to say the obvious perhaps, but also to evoke earlier parts of the book that deal with mass politics in previous eras of globalization, like the turn of the 20th century, with the populism of that era. If in mass politics people don't have meaningful voice in shaping globalization, many will oppose it, often using the nation state as a vehicle if they must, and it won't always look pretty because it tends to be a politics of resentment as opposed to a politics of solidarity. So this is all just to say that it looked like at the time, and I'm old enough now to have lived through this, that 2008 was a moment of great crisis for capitalism, but I think it's already clear in hindsight it was proved to be much worse a crisis for democracy. So I finished the book before COVID, which has put the events discussed in the book and also in my remarks in the rear view, and I think it's an important question to what degree COVID is going to result in a new age of capitalism. I suppose that's something we can discuss, but I think I will stop here, and thank you for your attention, and I look forward to our discussion. Thank you.
Thank you, Jonathan. That was perfect, very well illustrated, and very clear in 40 minutes. A journey, especially towards this last period of chaos, and seen from this little corner of the old world, we can see a bit of the chaos affecting us as well. And even if America is no longer the largest economy in the world since 2014. Certainly is the most influential in this part. Personally, I studied American multinationals, so the corporate actors of the visible hands of American capitalism and their effects on employment relations in Europe and their influence in a number of sectors, their way to manipulate and change institutions. We see how generally, even if China is a larger economy, what happened to Evergrande doesn't have the same effect as what happened to American technology companies, just to stay on the current affairs. Now, we start a series of comments on these important points on American capitalism. The first one, Pietro Catte, is the sunshine at the back? And we have the rising sun.
Moving in correspondence to the
Okay, I think the sun intends to keep moving unless something is changing. But if you want, you can also take this, because here there is a better position. As you prefer.
May I take my mask off to speak? What are the rules? No.
The rules is the same as in Rome. So unfortunately, we are required to keep
When you speak.
Keep the mask. I mean, if it is a problem for you.
Oh, it's okay. If you know.
Just keep the mic.
Me? Yeah.
Oh, the mic.
Jonathan tells us is a story of American capitalism largely driven by the expanding role of the financial sector. And there are three drivers in this process. I see it. One of them is deregulation. Deregulation is an important change across the economy, but particularly in the financial sector. A second driver is technology. Technology, again, there are important changes in the productive sphere as well with the new economy, but there is financial innovation, which is also a very important element, which interacts with the regulation in many ways, and sometimes can become a driver of the regulation or a driver of the push towards the regulation. And then the third driver in this process is monetary policy, and Jonathan shows this very well, outlining the role of the Volcker shock in setting up the conditions at the beginning of the period by subduing inflation and creating the conditions for a long period of easy monetary policy, which makes it possible to have a long sequence of asset price increases. Equity, through most of this period, there was a sequence of equity booms, and then after 2000, or starting in the late 90s and in 2000, also the housing boom, which would eventually lead to the crisis. Fiscal policy is a little bit in the background in this story. Jonathan doesn't give particular attention to fiscal policy. Maybe this is right, although there are moments when fiscal policy plays an important role. both, for example, during the Reagan administration, there were some important fiscal expansions through tax cuts and so on, which stimulated the boom in consumer demand, and also which had an impact on the financial markets because it created large large run-up in public debt. Now, all these drivers converge, as I said, in creating a sequence of asset price booms. And these asset price booms, with a large rise in equity values and then housing values, imply a large rise in wealth, household wealth, and also the wealth accumulated in the business sector. And this has important implications in the macroeconomic balance of the country. First thing, the rise in asset values encourages consumers to spend, and so we see a continuous decline in the saving rate of the household sector. I mean, the household sector at the beginning of the 80s was saving above 10% of income, and by the end of the period, by the years just before the crisis, the net saving of the household sector, once you take out also housing investment, so saving minus investment of the household sector, becomes negative, because the household sector is borrowing in order to finance the housing boom, and it uses more than its own saving to finance the housing boom. On the other hand, we have some sort of an unusual pattern, because we normally in an economy, what you have is that the household sector is the main sector that saves, and then it's a net lender in this sense. So it accumulates assets, and it's a net lender through the banking system, through the acquisition of other financial assets. And the government typically is a net borrower, so it issues public debt to finance the excess of expenditure over tax revenue. And the business sector normally is a net borrower as well, because it finances investment by selling equities and bonds to the public. But what we see at some point during the 90s is a very unusual pattern where the household sector becomes increasingly, it saves less and less and becomes a net borrower. On the other hand, the firms become a net lender. The profits of the business sector are so large, and their investment is not particularly high. It is high in the late 90s, but in other periods it's not particularly high, and this is a point that Jonathan has stressed as well, that it is actually accumulating net assets. It is a net lender, and in the late 90s also the government runs a surplus, so it becomes a net lender. So you have the pattern of sectoral saving and investment balances is a bit upside down, and of course the sum of all these sectoral balances, domestic sectoral balances, is the current account balance. So it's offset, it's an identity, is an accounting identity, is equal to the current account balance, which is how much the country lends or borrows from abroad. And during most of this period, the US runs a current account deficit. In some periods, a very large current account deficit borrowing from abroad. So this is an interesting pattern, and now these implications also interact with productivity growth, and we see that for example, during the new economy period in the late 90s, there is an acceleration in productivity growth, but during most of the period, productivity growth is not as high. So the run-up in asset prices, the big equity boom, which should normally be expected to reflect an increase in the valuation of firms, the prospective valuation of firms, and the fact that they are expected to create more profits should be based on productivity growth. In fact, this is not the case during a lot of the large part of this interval of time from the 1980s to now. And the other consequence, of course, is inequality. We have this pattern of growth centered on asset price increases tends to create inequality, and this has also implications for the political system, and this is perhaps not so visible during most of the period, but it became sharply visible 5 or 6 years. And now I want to go through a little bit the pattern of deregulation, just to highlight a few things. At the beginning of this period, this American financial system is highly regulated. I mean, there were restrictions to the possibility of creating new branches, restrictions to interstate banking. There was separation between commercial banking and investment banking, so the banks could make loans, but they could not deal in securities. This was the so-called the Glass-Steagall Act. And there were interest rate ceilings on loans and on deposits, which prevented banks from competing for funds and for business in lending. Now, this very regulated system started to crumble already in the 1970s, and a very interesting story is how this gave rise to the so-called savings and loans crisis. For example, initially, I mean, with these interest rate ceilings, one problem that came up in the 1970s was inflation. You know, with inflation, you could not hold these interest rate ceilings. There was enormous pressure to remove these ceilings, and this started to happen. But then what happened, also because the banks or some intermediaries had created some money market mutual funds, which were like instruments that were not deposits, but they could mimic deposits. They were, and they could set interest rates as they wanted. So it was a way to bypass the deposit rate ceiling. Now, this made it very difficult for the savings and loans to compete for funds and to continue to run their business, and so these limits on interest rates were relaxed. But then the savings and loans ran into trouble because they had fixed rate mortgages on their asset side and they were financing themselves at higher interest rates on the liability side. And so they started making losses. So who could they get out of these losses? Well, one idea was to allow them to lend also for commercial property, commercial real estate. This seemed a great idea at the time, but this implied a lot more risk, and because it was a much more speculative type of business. And in a situation where there was very lax supervision over savings and loans, the savings and loans took much greater risks, and in some cases engaged in outright fraud, in the way they accounted for their assets. And so at some point, the commercial real estate boom, because there was a lot of investment in commercial real estate, prices went up. But then in the late 1980s, the prices turned down, started falling, also because of the Reagan tax reform of 1986, which removed some tax shelters because it was a drastic simplification of the tax system. It was a very interesting tax reform, by the way. It was probably a very smart way of simplifying taxes. But one effect was that by removing tax shelters, it caused these commercial real estate prices to fall. And then all the losses of the savings and loans came up, and there was a need to bail them out, and there was a big cost for the taxpayers to bail out these savings and loans. There are similar stories in how the Glass-Steagall Act was removed. This happened a little bit later. Banks could not deal in securities, but then at some point there was a lot of pressure by banks to be allowed to enter this very profitable market. And so at some point, initially they were allowed to earn up to 5% of their revenue from investment banking. Then this was further loosened, and then in the end, in 1999, the Glass-Steagall Act was removed, which made it possible for the banks to engage in securities business, meaning buy and sell equities and all kinds of financial securities. Also, similar stories we have in the way the regulation of the derivatives, for example. The derivatives market grew rapidly in the 1990s. Many of these derivatives were not regulated. At some point, there was an attempt by the Commodity Futures Commission to introduce some regulation, but then it was stopped by the Treasury and the Federal Reserve. Greenspan was already chairman, and then in 2000 there was actually a bill, an act to deregulate entirely the derivatives market, and which made it possible for this market to expand even further. Now, all this deregulation was based on widespread trust in the ability of banks and other financial intermediaries to basically self-regulate. I mean, the idea was that you didn't need to regulate them because this business was so complicated that the regulators could not possibly draft effective regulations, and you had to trust the fact that these big intermediaries were able to understand the risks and control the risks they were running into. Now, the idea was that you needed to have just minimal regulation, light touch regulation it was called. And one part of the argument was that this would be in any case a zero-sum game. That, I mean, if there was speculation in the markets, you know, some people would lose, some people would gain, but it would not affect society at large. This was completely misleading because it didn't take into account what is called systemic risk, the fact that the composition of all the risks leads to a situation where there is a huge cost for the system as a whole. And now, in the end, this led to the crisis. And after the crisis, there has been a massive change in the other direction, in the direction of more regulation, forcing banks to hold more capital, to hold larger liquidity buffers, and these capital buffers have to be even larger for the big banks that have a potential systemic impact. So the banks are, the bigger the bank, the bigger the capital they have to hold, because the bigger is the potential impact of their possible failing. The perimeter of regulation has been broadened, although it is still incomplete, and the banks are subjected to stress tests, and there are regulations on the resolution of banks. So what happens if a bank fails? Things have to be set up from the start in a way that makes it possible to allow a bank to fail without creating a complete mess of opaque relationship with the other banks. And derivatives have been re-regulated, and in many categories are now forced to be traded in organized markets rather than over the counter. Over the counter means that people write contracts bilaterally, but nobody knows who has a contract with whom, and which makes it very difficult to monitor the liabilities and the interrelations, and makes it very difficult to unwind the situation if some big operator fails. Now, is this re-regulation enough? No, it is not enough. And by the way, it has also been implemented rather slowly with long transition periods. There is a risk of backtracking. There is a lot of pressure by the industry to backtrack, to remove some of these new regulations. And the risk is to continue to have the so-called regulation cycles. I mean, that just like you have a sort of a cycle in the market when, you know, the economist that Jonathan, of course, quotes because he's very important is Hyman Minsky, had already pointed out that when you have a long period of stability, this breeds confidence and risk-taking, and then when risk-taking continues to increase until at some point you have instability, you have a crisis. And similarly, you can have a situation, a cycle like this also in regulation. You have a highly regulated system which creates relatively stable conditions. This breeds complacency, and then people feel that you don't need to have all this regulation. You can relax the regulation because because the regulation is preventing a lot of profit opportunities. And usually innovation, and here again technology has a role, is often the justification to say, oh well, but now we have much more efficient risk management methods, and this time is different. Time is different, but in fact, we end up in the same place when we get a crisis. Now, let me just go a little bit to the monetary policy part of the story. Now, in the maybe since Jonathan has already explained very well what happened with the Volcker shock, I will focus on another element which is important, which is perhaps more closely related to the story I was telling of regulation, which is the so-called Greenspan put. That is the commitment by the Fed, or the implicit commitment by the Fed, to intervene and to support the market whenever there was a downturn in asset prices. Now, there were several episodes where this happened, where, like in 1987, there was a big drop in equity prices, and the Fed intervened very actively to provide liquidity and lower interest rate. Something like this also happened during the Mexican debt crisis in the mid-90s, the Asian crisis, and also in 1998 when there was the failure of the large hedge fund LTCM, and the other case, the other important episode is the bursting of the dot-com equity bubble in 2001. Now, there was a pattern in some of these episodes. You had initially these recoveries, the economic recoveries were relatively sluggish at the beginning, often jobless recoveries, and this justified having easy monetary policy. This facilitated an asset price run-up and also stimulated an economic recovery. And then at some point, this asset price run into some accident. Sometimes the occasional reason for the correction of prices may have been just a particular firm that had run into excessive risk, or the market which stopped functioning correctly. There was an asset price correction, and then the Fed intervened with large liquidity provision, and if necessary also easier monetary policy, that is lower interest rate. Now, this stimulated a whole discussion which was very lively in the central banking community, whether the monetary policy should lean against asset price bubbles, that is, whether when the central bank sees asset prices which are rising continuously, and there is a suspicion that they may be out of line with fundamentals, that is, the rise is unjustified by the fundamentals, should it lean against them? That is, should it tighten policy so as to slow down the rise in asset prices? Or else, the alternative would be to allow this to happen and just wait for the crisis to take place, the correction of prices. When the bubble bursts, the prices fall, and then the central bank just cleans up afterwards. So Greenspan was associated with the second strategy. That is, you allow this, the asset prices to rise, and then you clean up afterwards. And this was predicated on the idea that the central bank always had the tools, effective tools to clean up and to limit the cost to the economy of a bubble bursting. Now, what was the argument for Greenspan's put? It was called Greenspan put because a put option is a derivative instrument that allows to insure against a fall in prices. So in a sense, so it was said that Greenspan was providing this type of insurance to the market by intervening every time there was a fall in prices to prop it up. Now, the argument by Greenspan was the central bank could not lean against rising asset prices because it doesn't have the right information, doesn't have superior information relative to the market. So if the market is driving prices up, who is the central bank to tell that these prices are too high? The central bank does not have enough information. Even if it could, second argument, even if it could intervene to slow down the bubble, to do that, it would have to raise interest rates very high, because when there is a real bubble, just a modest rise in interest rates will not be very effective. And this would have a damaging effect on the rest of the economy. So just for the sake of stopping a bubble, you may you may create a recession, or you may create a problem in the economy. And then Greenspan also argued that, I mean, against the criticism that this was sort of an asymmetric way of reacting to the market, that you only intervene to support and you don't intervene to stop it, said, well, the problem is that the market is asymmetrical because the rise in asset prices is usually gradual and the correction is very sharp. I intervene when the correction is very sharp because this can create very disorderly conditions and can create large costs for the economy. Now, there were, of course, very good counter-arguments against this idea, and in fact, the central banks, can lean against the asset prices. The problem is that it's very hard for the central banks to do that alone. But the main counter-argument is that by doing this, by leaning against, by cleaning up after the crisis every time, and by preventing this correction, you tend to create the expectation that this will continue to happen. So you encourage more risk-taking, because every time the market prices fall, you intervene to support them. And this is what happened with the global financial crisis, that at some point the crisis was so large that the central bank no longer had enough tools to stop it. Now, so the outcome of this is that you have, of the discussion is that in any case the central bank is not all-powerful, is not able cannot hope to either stop asset prices from rising if you have a completely deregulated market, if you have an instability-prone financial system. So you need to have financial regulation in the first place to an effective financial regulation to prevent excessive risk-taking. And preferably you should have also additional tools like macroprudential policies, which means tools that can be adjusted as the risks increase. So when you see additional, the market, the economy taking up too much debt, you increase capital requirements and you force the banks, you force the other operators to take more, to put up more capital to guard against, and thus you slow you both make them more resilient, because if they have more capital, they are better in a better position to withstand a crisis when it occurs, and you slow down the incentive to take too much debt. I stop here. I had prepared to say something about the great moderation, which is also another theme in your book, and I can just say that. Far too long.
Thank you, Dr. Catte, for this particularly important insight on the deregulation side and the monetary side. Obviously, there will be even more to say, given the importance of this issue, the complexity, and so on. But again, we cannot exhaust everything in the book this afternoon, but I think we have quite a lot of food for thought. I would now invite Professor Pons, Professor of Contemporary History of Scuola Normale Superiore. I would... or there, yes.
Yeah. Well, since he's chairing.
By Jonathan Levy in his book, which shows a persistent or recurrent, I would say, role of political choices if we have to understand the different ages of American capitalism, even if the intentions of political actors may have not corresponded with the outcomes. This is a thoughtful approach, rich of implications, of the establishment of an historically based understanding of capitalism. As Jonathan maintains, I quote, "What separates the ages of American capitalism are not strictly economic variables, but rather political initiatives," unquote. The last one in his narrative being, as he said in his presentation, the Volcker interest rate shock of 1979, followed by the election of Ronald Reagan in 1980. I will try to provide here a few comments and questions on the turn of the final 2 decades of the past century, even if I'm not an expert of the history of capitalism, as you know. Let me start with some remarks on the aftermath of a global shock, which is so crucial to the book's last part, global shock of the 1970s. One of the major theses directly introducing to our times is that because of crucial decisions taken by the central bank at the end of the 1970s, essentially the decision to have high interest rates, a reconfiguration of US global economic hegemony followed. These are words of the author, lasting up to our days. I quote, After World War II, like other hegemons of the past, the United States was an exporter of capital and goods. After the Volcker shock, it became a net importer of global capital and the consumer market of last resort for the world's manufacturing export-led economies, including Japan, West Germany, and China. Unquote. Such a turn, if I am correct, represented the most coherent and influent action to translate into practice what had become already visible in the spirit of times, so to say, namely a globalizing capitalism emancipated from formal hierarchies in terms of gender or race, and a parallel marketization of societies, an argument which has been made by many scholars, for instance, Charles Meyer or Thomas Borsterman. However, as Levy notes, the new shape of American economy, as well as the new capitalism of the late 20th century, was not something policymakers expected and even less planned. My point is, shouldn't we also understand American supremacy in the aftermath of a global shock as a goal that policymakers pursued strictly in connection with the late Cold War contest? For instance, Jonathan mentions that the recession induced by Volcker's strategy hit very hard East European countries, particularly Poland, generating what has been called the kiss of a debt by Stephen Kotkin, a mortal kiss. Communism would perish, as you write. This may be a bit exaggerated, as the end of communism was actually the consequence of a number of factors, complex compound of long-term problems, contingency, and fatal choices, or non-choices. However, the question is whether political choices were even more influent because of a Cold War-centric American strategy. Is quite marginal in the book. Reagan's objectives in terms of political economy may have been different from the final outcome, but to what extent the materialization of a new kind of capitalism was more or less consciously perceived as a way to maintain American primacy in an interdependent world, and even more as a way to put pressure on the Soviet Union, as the Soviet Union could hardly adjust its economy to interdependence, not to speak of its capacity to absorb the Polish debt and avoid the delegitimation of the communist regime after the emergence of Solidarność. So I asked Jonathan if having more Cold War into your picture could be useful for an understanding of the balance between political intentions and final outcomes. Second question, the book does not treat the relationship of the United States to the Third World. I understand this is a very wide and complex issue, of course, which would have taken the author too far away from his main focus. However, some notes on the 1980s would probably help reinforcing the perspective of a major turn combining politics and economics, and would possibly integrate previous remarks on the Cold War. The response of the USA to the challenge of a new economic international order put forward by non-aligned countries by the mid-1970s was in many ways consistent with the turn of the early 1980s. The connection between the central bank and the International Monetary Fund were successful to impose their own rules of the game in the management of a sovereign debt in the Third World, namely an enormous extension of conditionality and a deep weakening of sovereignty. We may speculate whether the main third world countries were really capable of unity and coherence in their confrontation with the United States. They were not. Furthermore, they were disconnected from the socialist camp at this point. And still, wasn't the new role of the International Monetary Fund the result of a strategy developed during the first mandate of Reagan? Here the question is how the objective of maintaining powers in the real new international economic order, as Mark Mazauer put it, was important to domestic developments in the USA and their consequences for the world. I come to my third question. Jonathan remarks how globalization, I'm quoting, globalization, however the word is defined, was not new. But during the 1990s, a new global cosmopolitan consciousness was born. During the 20th century, by choice or by necessity, industrial capitalists had tied their fates to nation states. Now, many owners of wealth were not so sure. New York, London, and Tokyo, all centers of finance, became recognized as global cities, where new forms of private global governance emerged in lieu of state regulation, unquote. At the same time, your conceptual assumption is that, I quote, US hegemony facilitated economic globalization. Economic globalization needed US hegemony, unquote. This was clearly visible as the Clinton administration emphasized the neo-internationalist perspective of a global so-called third way and American exceptionalism at the same time. So, okay, but what was hegemony at this point? Can we really use the same concept for American sovereignty and power in the world in the aftermath of the Second World War and then again at the end of the past century? We know that the economic role of the US had radically changed. I should not underline that. Besides that, the idea that marketization, deregulation, and privatizations could provide automatically democratization, security, and the rule of law on a global scale was something very different from post-war thinking and approaches. My point is, can we assume that what Jonathan defines as an end-of-millennium fate in a finance-led vision of globalization persisted in the aftermath of 2008 may represent a declination of historical hegemony as distinct from sheer power, perhaps declining power? And what about the post-Cold War languages and practices of human rights with their corollary of humanitarian interventions? Have they constructed a framework of multilateral consensus as it was during the Cold War in the West? Or rather, they left a divisive legacy in a growing multipolar world? In other words, my argument is that I wonder whether we should reconceptualize our lexicon when the debate comes to the problem of hegemony at the end of the past century and in the new century. For instance, we may better understand what has happened from the 1980s onwards as a kind of passive revolution, in Gramscian terms, which either subverted or reshaped political and welfare constraints on capital, both in their democratic and authoritarian variants. At the same time, such revolution without revolution of globalization soon showed the signs of contradictions and new sources of instability. Deng Xiaoping's China may be seen as an integral part of global developments under American dominance. By the end of the century, China had already emerged as a state-led model of capitalism, or precisely a party-state Leninist model, well established in the framework of globalization. The global link of interdependence between American and Chinese economics is convincingly underlined in the book and also in the presentation, as you showed us. But China's ascent also outlined a new world order potentially challenging American power. In the world seen from Beijing, there was no age of chaos, not even when the crisis of 2008 erupted with all its global interconnections. As Adam Tooze has observed, at the start of a new century, Washington saw China as a possible responsible stakeholder in the world economy, and then the question was reversed. A truly multipolar world was born. This is just to say again, and I conclude, that we probably need further reflection and discussion on the question of hegemony. Thank you.
Thank you. Thank you very much, Silvio, for this insight. In fact, American capitalism, in the term American capitalism, the word American has two meanings. It's a geographic qualificator and an ideological one, especially if one looks at the external effects and role of American capitalism, which makes me think of, just to add an anecdote, talking to the first democratic post-communist culture minister of Hungary, who had the role of privatizing broadcasting and the media, and invited American experts to know how to do it. And they told them, well, you listen carefully to all the advice, and then you ask questions. So you have to privatize all broadcasters? Yes, you do. To the best buyer? Yes, even if they're foreign? Oh, yes, of course, the first best buyer. Is this how you do it in the United States? Oh, no, this is not how we do it in the United States. It is, which shows the distinction between the ideological and the geographic denominator. We move now even more into the political and social side of American capitalism with Donatella Della Porta, who follows us from Berlin. Donatella?
Thank you, Guglielmo. I don't see anyone, so if there is any technical problems, let me see someone.
At the moment, yes.
I see Jonathan now. Hello. Indeed, I have to start with a disclaimer. I know little about economics and I know little about the United States, but I know something especially on the political and social processes in the countries. So I was extremely pleased to read Jonathan's books, especially on the age of chaos, to sort of complement my own knowledge. And I thank Jonathan for having thanked us for having got him a couple of years ago. And we look forward to host him again after this presentation. What I was thinking when reflecting on the terms age of chaos and on the content of this part is that indeed we use terms like chaos, or when we think about varieties of capitalism, we consider the American capitalism as an example of liberal markets rather than coordination of markets. But it seems to me that what we are looking at is an extremely cohesive type of developments, with both parties considered to be very near to Wall Street, to use a slogan, but especially a very effective capacity of lobbying by an oligarchy that seems quite strong. Now, Jonathan rightly gives a lot of importance to the state in the development of the different ages of chaos and also the shifts from one age to the next, but more to the state than to politics. Guglielmo said it is a huge book, and of course we shouldn't add complexity, but to a certain extent combining the history of capitalism with a more political history, like Silvio also did before me, I think would help embedding the history into a more complex one. So in my fields of scholarship, the United States say panorama of social movements seems to indicate quite a lot of specificities that may explain also the label of an exceptionality that has been often allocated to the development in the United States. So especially looking for explanations in my field to this type of developments, I think that some characteristics of social movements and civil society in the United States could help explaining some of the development and some of the American exceptionalism. On the one hand, the very high fragmentation of social movements. On the left, on the other hand, quite low ideological commitments by these fragmented social movements, and especially the weakness of the labor movement, to which Jonathan referred, but that's a totally different role in Europe and in the United States. From the political point of view, say, the United States, what is it a case of? Literature on the variety of capitalism stressed the sort of disorganizations, market liberalism versus the organized forms in Europe, but also it points at the strength of an elite, a la Mill's sort of oligarchy rather than a polyarchy. With neoliberalism as a sort of assuming a sort of barbarian forms in the United States. And during the pandemic, these differences were quite visible with, for instance, the consequences of inequalities towards the pandemic in a country in which health insurance left still a large part of the population uncovered, there were no employment benefits, and so on. In trying to explain this development, when looking at social movements and politics, what emerged is the hollowing out of political parties, according, for instance, to a recent book by Sidney Tarrant on movements and parties, with the consequences of occupation on the right of the Republican parties by, according to Sidney Tarrant, a sort of octopus. The octopus formed by the brothers Koch, that's according to this type of research, also played an important agency role in the development of, on one hand, libertarian visions on economic issues, and on the other hand, ultra-conservative visions on social and political issues. What scholars point at is that the octopus is different from the traditional lobbying, and that it has been extremely influential in the developments of in the hollowing out, let's say, of the Republican Party through the development of the Tea Parties, and then to the with the development of Trump, and probably also in the post-Trump areas. They locate this, let's say, hollowing out of the Republican Party as a consequence of three main changes. The primary reform in the 70s, the campaign financing reform, also dating since a few decades ago, and the Citizens United decisions of the Supreme Court that allowed for virtual, unlimited, and almost anonymous type of funding. So a sort of archipelago of white nationalism, evangelical Christian, and anti-black, anti-Semitic groups that's penetrated the US politics by occupying to a large extent the Republican Party. So this would be an explanation coming from reflections on social movements and parties on the right. What comes from social movement literature is, however, that this octopus and Trump and all the related political development on the right could be resisted. On some occasions, Obama did resist them. On some occasions it failed, but on some occasions with some success. So the expectations is that resistance could be effective, especially if it aptly combines developments in political parties and in social movements on the other side, so on the progressive side. And there are also the questions are open for what also Jonathan is calling for. In the last pages of his last volume, I think it's in the afterwards, he wrote, "A democratic politics of capitalism is called for." And also in the presentation, Jonathan mentions the crisis has been more a crisis of democracy, even more than an economic crisis. So moving on the other side, one of the common challenge for scholars of politics and social movements and scholars of economics like Jonathan is to think in terms of what could create the critical junctures that could produce the shift from one age of capitalism to the next. And here I would like also to ask Jonathan to develop on the point that he couldn't address in the book because, as he mentioned, it was closed before the pandemic, but that for sure he will address in the future. So what could be now a critical juncture? You explained, Jonathan, that the type of development that helped in the past to shift from one age to the next, also in a progressive way, for instance, with New Deal, in moments in which labor reconquered some spaces, were driven by the development of new type of intervention by the states, especially on investment. Now you said the American economy has reached a point of repetition, and you consider the Fed as a sort of broken record. So what are the chances now to go beyond and break this type of repetitions? What are the chances for creating a critical junctures, and how can this change look for? On the one hand, we know that the pandemic has to a certain extent worked as a critical juncture because it forced states and international organizations to do things that they had not done in the past. We know that there is a struggle, that no change will come without conflict, but also that there have been moments in which these sort of positive interactions between social movements and political parties on the progressive side has developed from the Occupy movement to the Black Lives Matter. So it's this shift from income to labor that in the past was happened thanks to income politics, possible in this moment if this type of potential for changes materialize, and how should we expect, on the one hand, a very strong and convergent type of oligarchy to react. We are studying with Mario Pianta and Giulio Marcon the rich people, and it seems that the cocktopus is a sort of extreme form and very effective forms of organization of the rich. But what can we expect the other side as well? Thank you very much. I think it was a very long and intense afternoon, so I prefer to be short and give the floor back to Jonathan with many thanks.
Thank you, Donatella. Now, before the floor back to Jonathan, we obviously have, last but not least, the chair of the Ciampi Institute, Professor Pianta, for some final comments, after which I would already invite people to raise questions. We can have 2 rounds probably, but both those who are online, if they want to do it through the YouTube chat, and those who are here by raising their hands in a more traditional way, please think about possible questions for the discussion later. But Professor Pianta first.
Thank you very much, Jonathan, for this opportunity to discuss wide-ranging topics. I will just put my argument in 4 questions, which connect to different points that were already raised. I liked very much the chaos term because it reflects a conceptual understanding of the changing orders that we are discussing in the economy, in society, and in politics. And I think it's quite appropriate. And so the questions are all related to some different aspects of chaos. So a very important point that you discussed very well is the view of a model of capitalism after 1980 based on asset appreciation, on continuous systematic appreciation of assets as a way of specific form of finance expansion. I think the question is, how can this model end? Because we are really facing a period with the Fed announcing a rise of interest rates. And
what we have seen was an anticipation of an end of this model with the 2008 crisis, if not before, but in the end, the monetary policy continued to be more of the same, and the same happened with the pandemic crisis. So crises have not been moments of challenge and shift in the model of capitalism based on asset appreciation, rather have been deepening this model, it seems to me. So the question is, how can this end without a major collapse or crash? Conceptually, this point is very much related to a stream of research, which is quite important, which has been investigated, the succession of periods of material expansion and of financial accumulation, and in the view, already in Marx we have some of these ideas, but Fernand Braudel or Emmanuel Wallerstein or Giovanni Arrighi developed this idea of a sequence of cycles of accumulation based on material investment as opposed to financial accumulation. And this connects us to the second question, which has to do with hegemony and the chaos in the world order, which Silvia Pons already addressed. My question here is more specific. How did the US, in your view, benefited from its hegemonic position through this model of financial accumulation? Because clearly that what you pointed out, the US becoming an attractor of world capital flows and having the opportunity of having a free lunch on a very large number of cases. So do you think you can connect the role of the US in terms of world power to the condition for this model of asset appreciation? Clearly the interest of the book, focusing on the US, is that the US is at the top, is at the center of the world economy and at the center of a world hegemonic system, and therefore the relation, but this would be another book of course, the relationship between the dynamics in the domestic political and economic sphere related to the continuing position of leadership, but which is already challenged and in crisis. And this is really a period of efforts by the US to restore its international position through different elements. So the question here is how this model was able to benefit from its international power, basically. Third question on the social dimension, already Donatella pointed out this question. A model of economic development has to have an ability to distribute benefits and to organize consensus and support. And what we have seen in the last 10 years is the collapse of this ability of the system to have a cohesive distributive outcomes, not just looking at data on inequality, but also looking at the social mobilizations that Donatella mentioned that have emerged. And Trumpism is a paradox because it combines some elements of extreme continuation of past policies with elements of complete disconnection, reversing some of this policy, but manages to have the consensus of both parts of the financial elite and parts of the losers of this system. So the connection between political processes, social behavior, and economic models is completely chaotic in this sense. So what can we envisage next? Finally, your book is particularly strong on investigating the policy shifts where political events and political decisions reshape some elements of American capitalism. From this perspective, what is surprising to some extent is the resilience of this model, because this model was able to surviving the 2008 crisis without any limitation on capital movements, without any taxation on capital of significance, without any significant restriction of finance. And here the question is also to you. You pointed out the extent of new regulations that have been introduced, but if we look at the dynamics of the Wall Street stock prices, if we look at the continuing expansion of more speculative types of finance, do you think these steps were enough to stabilize the system? But it seems that the system was able to resist political pressure. For instance, Elizabeth Warren demands for regulation from the inside, and continue more or less the same model of asset price inflation. So policy shift did not happen in 2008, and it probably are not happening with the pandemic crisis, when again we see more of the same, but at the same time may happen with the rise of inflation and the Fed changing policies. Do you think this has to do with the weakness on the political side, that is not enough counterforce in political terms against the continuation of the established policy paradigm? Or do you think the degree that finance has achieved, the degree of pervasive presence throughout the economy and throughout our lives, makes it very difficult? So again, how can this possibly change? Thank you very much.
Thank you, Mario. As an economic sociologist, so not a historian, not an economist, but economy, you can look at it from any kind of perspective. Actually, I think democracy, everybody has a perspective on it. The point of consensus, the economic sociologists have put it in using concepts like privatized Keynesianism, Colin Crouch, or borrowed time, Wolfgang Streeck. So they focused on some of the aspects that Jonathan studies and describes in the book, exactly from the perspective of consensus after original, let's say, public Keynesianism had entered into the problem of the fiscal crisis and the electorate unwillingness to pay more taxes, which Ronald Reagan famously, or notoriously, exploited. Now, we have had inspiration from the side of monetary policy, from the side of history, from the side of politics, from the side of political economy. Jonathan, do you feel like you want to answer some of the suggestions? Yeah, let's start now. In the meanwhile, I hope there will be questions from the floor as well.
Yeah, let me answer all the questions that have come. There's a lot on the table, a very rich set of remarks, so I thank all the commentators. Briefly, I'll try to touch upon maybe a little bit of everything. I guess the first point I want to make goes back to Pietro Catte's remarks, which I liked. I mean, this is a seminar on neoliberalism, I think, for many of the students, that not all, but I still think too much work on neoliberalism focuses on the ideological register. So Hayek, said something, and then Thatcher gets elected, and then all neoliberal hell, breaks loose. That ideological register is important, but I think many of the issues that Pietro was talking about, the kind of, okay, well, there's inflation, so there's caps on interest rates, and how do you handle that, and the kind of unintended consequences of policies, that register of political history, it was really important to understanding this period, this transformation, understanding whatever neoliberalism is or isn't. So I really appreciated that remark, which actually relates to what Silvio Pons brought up about this model of political initiative mattering, being the most important variable, but unintended consequences often being causally, driving the story. And he brought up the Cold War as an area in which politics might look more intentional, or the gap between intentions and outcomes might be tighter than I suggested. I think it's a great remark. I mean, maybe just to run with it, actually, and to argue against myself, argue against what I said in the book. I mean, it's true, post-Volcker shock, you know, if you look at the kind of world economy as an accounting, national accounts, you see this reverse of capital flows and also exports and imports, which is very different. But it's also true that coming out of the Cold War, immediately after World War II, in part because of the limits of their power, but also because of Cold War considerations, the United States decides to let Germany, West Germany, reindustrialize, decides to support the industrialization of Italy and other countries. And so there actually is a model which gets amplified after 1980, greatly amplified, in which the U.S. is going to be the consumer market for world manufacturing, export-led economies. It's the China model, too, is actually rooted in kind of earlier Cold War considerations. It's also true that the Reagan boom greatly depended upon budget deficits, and budget deficits were legitimated in terms of the Second Cold War as well. So it's sort of a very specific legitimating role for what the Reagan economy actually looked like. I do think well, let me say one more word about that too, actually, because it relates to Donatello's points and also Mario, that the United States, as a fragmented, I think the word oligarchy actually makes sense. It's true that the only time the United States in political economy is able to legitimately, right, invoke the public interest and shape the political economy has been in times of war. And so reference to national security, whether it's the Cold War or even more recently China with Biden, I mean, this tends to be the only way you can unify a public behind a set of policies. It's a very troubling feature of the United States, but it goes back to Cold War logics in large part as well. The 1990s, I think, is different, and the global scale looks different, and I think can't be explained in terms of the post-war, Cold War framework. Let me just talk about the dollar, because I think it actually speaks to a lot of the issues that have come up. So when we think of U.S. hegemony in the late 1990s, we think of finance, we think of the role of the dollar as the world global currency of reserve. And the question becomes, is that a reflection of U.S. hegemony, or is that a reflection of the ways in which global owners of capital use the dollar as a function of their own interests? And of course, it's both. So what does it allow the U.S. to do? This gets back to Mario's point. Well, it allows the U.S. to consume much more so than any other country can consume. And that does create a kind of cohesiveness in terms of what Americans get out of this. Well, they're able to consume more things than anyone else in the world relative to their incomes. It also directly benefits financial interest, Wall Street namely. But I think it's also true to look at the China shock back, that U.S. hegemony in the form that it's existed since the 1990s has not been, and this is important for explaining Trumpism, has not benefited large regions of the country. So I think when you say, and maybe this is something I was guilty of in the book, when you say U.S. hegemony, you have to very quickly disaggregate, who's benefiting from a particular global configuration of the United States, and who's not. They're as important as the research on kind of right-wing, nationalist, violent social movements in the United States is, and that research is not integrated into the book as well as it could be. With that said, I still think we're living in the aftermath of a failed vision of globalization presented in the 1990s that failed to deliver on what it promised populations. That vision was a center-left vision. Clinton, Blair. And so as scary as these right-wing social movements are, as bad as they are for the United States in many respects, I still think a lot of responsibility needs to be placed on the center-left. And there, I think there needs to be changes or transformations before we're going to move out of the age of chaos or get out of the political economy of asset price appreciation to move into another age. So just briefly on some thoughts there. I mean, prospects, especially coming out of COVID. I mean, this relates to Mario's point of, okay, well, how does this work? Why does it maintain itself? One reason I think has to do with consumption and the link between consumption and American citizenship. If you look at the COVID fiscal stimulus bills in the United States, they're all about supporting incomes and sustaining consumption, which is part of the reason why, given supply side constraints, there's the inflation that exists in the United States. So that's a linchpin of the political economy, and starting to see the production side, labor side, and of course capital investment side of the economy as the site that needs to be politicized as opposed to consumption is definitely important, part of the solution. I think also on, why does it persist? How does it work? There you really do have to look at geography. I mean, I'm from Houston. I grew up in Houston, Texas. I mean, you go to Houston, everything's brand new, it's shiny. I mean, you kind of see this real estate driven, service driven, consumption driven, automobile driven model of economic development that's thriving. I mean, I live in Chicago now, which is a city suffering from, a horrible series of crises having to do with violence, having to do with economic degradation. So the United States has parts of the country that tend to vote Republican where there's certainly economic dissatisfactions in terms of inequality and other matters, but economic life on the ground is much more vibrant, shall we say, and promising than other parts. It's hard to be optimistic about politics anywhere. That includes the United States. I think I would point to maybe 3 or 4 considerations where if you wanted to be optimistic, you could be. First, I think COVID, the lesson has been learned that the fiscal capacity of states, including the United States, is much greater than perhaps we thought. Haven't seen, not yet, maybe we will, a pivot towards a politics of austerity like we saw in 2010. I think that is different. I think second, and here I do place responsibility with the Democratic Party, much more so than with the Republican Party, as awful as the Republican Party is, progressive economic policies for the United States, like universal health care, are extraordinarily popular. I mean, they poll at extraordinarily high levels. It's just that they're not legislated. And again, responsibility lies there with both parties, not just the extreme right or the kind of Trumpist right. Actually, Trump on health care, well, it's very chaotic, but played both sides of the divide throughout his politics. I think third, perhaps, and we'll see how this plays out in terms of inflation, there's been changes on the labor side, which is what's called the Great Resignation now, about the willingness of many American workers to quit, which has helped push up wages, has helped tighten the labor market. I think that has to be part of any politics within the United States that would get us into a new moment, a new age, which is finding ways to get leverage on the labor side to start growing the economy through an increase in labor incomes as opposed to asset prices. And then finally, this does have to do, relates to the earlier set of remarks about war and how important war is to the book as a whole. Obviously, climate change is where politics moves in that direction. Certainly in terms of thinking about the politics of investment, if the need for more robust programs of public investment, climate policy will be the arena that plays out. And we'll see. I mean, if American politics can wield some notion of a broader public interest, not through war, not through national security, not through saber rattling against China or Russia, you would think climate would be the arena in which that. So thank you for all the remarks, and I'll stop there.
Thank you very much. That was very, very good. We heard a lot of the term liquidity and then a lot of the term chaotic. So I'm sure there is still something to be explored. We have Francesco Bagnardi.
Ciao. Thanks a lot for the presentation, Jonathan. I didn't read the book yet. Maybe this question would sound a bit off. But I was wondering, especially touching upon the question of both hegemony, chaos, and the free lunch that Mario was talking about. You know, the question of the protection of intellectual property rights, that is something that is completely built from scratch under the US push, actually, in the 90s. I think it's one critical juncture, if you will, that is really lying on that specific historical period in which the US is able to create something out of the cooperation that is based on the cooperation of every single state, and it is still going on, and it is creating asymmetries, it is creating the dynamics behind the free lunch of certain states over the others, and it's also explaining the possibly, or maybe raise more question than explanation on the resilience of these systems today that we are facing the vaccine patent waiver debate. So I was wondering, where do you put this in your explanation? At which point, on which organized interest it works, and how important is this part in the building of a new hegemony or in the looming chaos that is emerging? Thanks.
It's a great question. I don't think I have an adequate answer to it. I mean, two things come to mind specifically about intellectual property. That's second on the question of hegemony, which goes back to some of the remarks that we heard from earlier discussants. So the asset, you know, the kind of asset price appreciation model. I mean, one of the ways it works is through the inflation of values for existing assets like stocks in companies or homes. But there's another element too, which speaks to technology, which is the synthetic creation of new assets, which can appreciate in value too. That's very important in biotech, in healthcare. It's very important in information technology. So when Google claims proprietary access to their algorithms, or Facebook, they make intellectual property claims, calling new, creating new forms of property and new kinds of assets that can appreciate in value. So that's maybe not discussed in the book as much as it can be, but the first decade of the 21st century in finance, in the kind of synthetic creation of mortgage-backed securities, but also in Silicon Valley, finding new ways to turn information into appreciating assets. You know, it's kind of something that happens across the economy. You're exactly right. I mean, it's a huge part it's a huge aspect of the disagreements between the United States and China, with which they exist, over these intellectual property rights in the U.S. and also in China. It's a big part of the Trans-Pacific Trade Act and why it didn't succeed, and why the Obama administration was promoting it as much as they could. It brings to mind maybe just a last remark on this hegemony question, which is really a cop-out, you know, but as a historian, it's something I'm kind of allowed to say. You know, it's too soon to tell. You know, the Braudel, Wallerstein, Arrighi model would suggest that after an era of financialization in the U.S., we should see a passing of geopolitical power to the new country, which is now specializing in commodity production for the world economy, which suggests you would see a transfer of power to China. But I'm not sure that model will work, because I do think, despite the past history of globalization, that the global scale looks different today than it did. And that there's a way in which, say, the US dollar the hegemony of the US dollar might work more to the interest of China, given its model of economic development, than it has worked for the US. I mean, we tend to think of the US dollar as representing the exorbitant privilege of the United States, but that's not so clear. But if you looked at intellectual property, your question, then you do seem that it does look more like a rising power contesting, right, the existing power, or the existing power trying to ward off, fend off the rising power in a very direct kind of geopolitical sense. So you can still tell both, you know, stories. this looks old, just with new people occupying, or new states occupying the same old roles, or you can tell a story in which globalization has changed things in fundamentally different ways, which will make geopolitics, look different within the economic field. And it's not clear which way it's going to go yet.
Hello, thank you very much for this very interesting discussion. Kind of a long trip into the US capitalism. I haven't read the book as well, but I'm looking forward. So you start in the beginning with some excerpts of Keynes' internal theory, which I found very interesting. And you said that there has been this chronic propensity to save, which is bigger than the inducement to invest.
Yeah.
And you connected this with the political economy of price appreciation. And I'm wondering to what extent this epoch reaches its limits in a period in which, even before COVID, there was this secular stagnation of, as it was called by Summers, in which the private sector was, there was this bottleneck in which we didn't have much investment, and we had a growing voices of people saying that the state has to step in. And this now we see more, part of the Build Back Better plan of Biden, allocate sources into long-term infrastructure projects. So with fiscal policy returning and the state being more developmental right now in order to mobilize investment and create momentum, to what extent this epoch of price appreciation stops and paves the way for something else? More long-term infrastructure and investment projects that go back to the depreciation that you were mentioning.
Yep.
Thank you.
Love the question. I mean, the secular stagnation thesis, which you're right, has been proffered by many economists recently, including Lawrence Summers, actually goes back to the Depression. It's an American economist named Alvin Hansen. You can read it in Keynes. This is actually the way that Schumpeter read Keynes, which is to say that this problem, the kind of weakness of investment, is an issue of really decadence, right? The kind of after an end of economic development, the rate of return on capital is lower because there's been a greater accumulation of wealth, that there's been so much economic development, and so you're stuck, you're decadent, and then maybe the state can intervene. I guess my perspective is different. That I don't see that problem, that the inducement to invest is weak, as something that happens at the end of economic development, indicating a fading or a kind of decadence, which I think actually you could read into the Origi kind of scheme of things too. But rather, this is something more like a normal state, right? Like this is actually a kind of baseline state that we should expect to be true. Which I think actually helps explain the lateness of capitalism as an economic system. It's a very strange, very odd economic formation given the long sweep of U.S. history. But it also suggests that, as you said, that we can imagine the political economic conditions, and I think also the broader conditions in terms of culture, society, and so forth, in which you could get radically new economic departures. And, World War II, and the aftermath of World War II, I think, proved that instead of secular stagnation coming out of the Great Depression, you had the decades that were, highest growth, highest productivity of any decades on record in world economic history. So I think, the questions are political, which is what we've been talking about, and I think that's where one gets depressed. But in terms of the economics, the economic possibilities, as Keynes said, anything that can be done that's worth doing, can be financed. Right? I mean, technically, there's a way to do it. And so here, I hope, instead of war being the kind of active agent that propels economies forward, or propels us out of that state in which liquidity preference has triumphed, one would hope that climate change and the kind of urgency around climate change and climate politics could be that catalyst. But once again, these are political questions. I think rather than the real interest rate is this, or the natural interest rate is this, and so we're caught in stagnation and we can't get out. I think there's good reasons to be pessimistic about politics, but not economics, I guess.
Another call for questions and another hand. I'll be very happy if we rebalance a little bit the gender distribution, which already has been affected by Manuela Moschella's default.
Thank you. Thank you very much for the talk. I really enjoyed the presentation of the book. My question relates back to this idea of sort of linking the challenge, the practical challenge of the green transition and the distributional challenges that are in the asset appreciation regime. I think there's a natural tendency to link them because it's sort of the nature of decentralized investment, which leaves us without sort of the means to confront the climate change. If we had the state planning body or if we had some type of coordination, as in the war economy, you can imagine that these sort of big investments would happen at the scale necessary. And I guess what I would like to ask is it possible that one of these challenges might be surmounted without the other? Is it possible that through, on the one hand, either like greening international finance and sort of working within the existing policy portfolio of central banking, we can sort of facilitate behavior at a more decentralized level? Or is it also possible that given changes in the nature of production and given the role of IP, in particular in distributing profits, we could see a sort of green investment program that would actually continue to perpetuate our asset price appreciation inequalities? Thank you.
It's a great question, and I think you're right that it's possible to imagine a kind of greening of investment which could perpetuate the dynamics of asset price appreciation and not maybe fix other parts of the economy. The last part of the book, deals with a number of different episodes. The 80s, the commercial real estate, boom is one, the new economy is another, where there's a certain model, and this came up earlier, that, we think there's some underlying economic reality that financial values are supposed to reflect, right? Equity values are supposed to reflect corporate earnings at some point. The value of commercial real estate is supposed to at some point reflect like the actual need for the use of commercial real estate to engage in actual commodities, the actual production of goods and services. But I think one thing we've learned because of how supportive credit conditions have been from the Fed, that if money and financing are available, if they're not scarce, you can drive up the value of any asset that you want. So this will really maybe expose the age differentials in the room, but non-fungible tokens. I mean, in the United States, I have friends who are showing me non-fungible tokens on their phones, that have gone up, thousands of dollars in value over the last month, just because somebody wants to buy, somebody's willing to, value it. So I think you're right. The same thing could happen with the greening of the economy. Now, of course, if it actually changed the energy system, there would be, benefits to it. But I think it's an important remark. It's really important that the content of asset price appreciation could change, and it could be better in terms of things one might want for political and moral reasons. But some of the other issues in terms of distribution might not necessarily get addressed.
Last call. YouTube seems silent. Questions? I see one from the extreme left. I mean, geographically and not ideologically.
Well,
not necessarily, at
least. Let's see.
So let's say my question is a bit about U.S. politics in a way, so on the medium term at least. So also from the previous question, I see that of course there is a lot of interest, for instance, in a possibility of a new wave of investment in that help heal the situation with that we know about the environmental crisis and whatever. But there are also many problems, not on the financial, but also on the real side. So, for instance, I was just reading today about the fact that, for instance, the potential boom with solar energy in the US is stalling because of sanctions and regarding the Xinjiang region in China, or the trade policy inherited by the Biden administration from the Trump trade wars. So, in a way, we see that we need more cooperation. That looks really obvious, no, from a certain point of view. On the other hand, we see that instead geopolitical tensions are, growing and growing and growing. So my question is, what do you see the chances of, seen from the US, that, let's say, is it possible to have a non-hegemonic globalization in reality? I mean, is this really acceptable from the point of view of the American political system? Or are we, in a way, or is it more likely that we are going to see the hegemonic power endanger the entire, international framework of cooperation in order to preserve its own hegemony? So, of course, these are two very, very black and white outcomes. So, but where are we heading? What is more likely, to see in the next future in this sense? So, thank you.
So it's the big question. I mean, certainly since Obama, and Trump did it in a very different way, but in some respects, Biden has continued that policy, that the United States has shifted, right, towards China, viewing China as its largest geostrategic competitor. And so I think, is the United States prepared to further globalization without the United States itself being at the center as the hegemon? I think the answer is no. Although 10 years ago, the answer would have been no, 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 no. I mean, in the sense of, I think that there has been changes there where it's possible to imagine the United States accepting a lesser role within the world economy, within world politics. I think the other question, which I'm not qualified to answer in any way, is what does China want, right? Because I think China, on the one hand, clearly, strategically, affected a model of national economic development that fully assumed it would operate within a world in which the United States was hegemonic. Now, of course, it carved out exceptions to that in terms of capital controls, in terms of intellectual property, but nonetheless took the fact of U.S. hegemony as given in its policies. And to what extent have we seen a shift away from that in the last 10 years? There's been some shift. We think of the Belt Road Initiative, we think of other kinds of developmentalist policies, but it's still maybe not clear to what degree China wants to, the extent to which it can, which is also another, there might be limits there too, to challenge a version of globalization in which the United States, in many important respects, if not all, is hegemonic. I think maybe I'll just finish with one last remark, because it goes back to what Silvio said. There's another dimension of hegemony, which is ideological, which has to do with the attractiveness of these different models to the world at large, outside China, outside of China, outside the United States. There, despite the fact that the United States, in many objective metrics of power, both in terms of military power and also economic power, remains hegemonic, I think, I suspect it's lost other sources of powers because of the financial crisis, because of Trump, that make the United States much more so look like, a declining power relative to others than it did, say, once again 10 years ago.
maybe the last call. Otherwise, I would ask maybe Mario to wrap it up.
Thank you very much. I think we touched a very large number of issues, and we are thankful to Jonathan because he is challenging us to bring together with this learning from his historical perspective how we can inform our specific investigation on political economy, social politics, political institution, international relations, and so on, and frame our work in this wide-ranging perspective on the long evolution of the U.S. in the context of the world system. Let me remind that today the seminar was part of the course on the political economy of neoliberalism, and so I invite the students to make the most of this opportunity and to consider to work for their exam paper or some of the issues that we've been discussing today. So this is an interesting springboard for a number of research questions that can be developed, both in the course and in the broader PhD trajectory of the students. Clearly, this conversation will not stop today. We hope to have Jonathan again with us, and it will be interesting to involve more closely the Bank of Italy to discuss what can be done in terms of policy challenges for coming out of the current chaos, with Europe hopefully learning from mistakes of the last decade after the 2008 crisis. And we have an interesting connection with the lesson from our own historians in Pisa. So sometimes the Pisa-Florence divide is as wide as which is rooted in important historical experiences. We can bridge this divide with more initiatives that combine historical perspectives and social sciences. So thank you also to Donatella, who is bridging the Italian-German divide in Berlin. And thank you to the students and the participants. I remind everyone that the seminar will be available on YouTube, on the channel of the Scuola Normale Superiore on YouTube, and this will be an interesting learning opportunity for those who are not with us today. Thank you very much, and thank you, Guglielmo.
Thank you.